Hello, guys. Good morning and welcome to your show. Listen. Okay, first I better do the date. Today is November 14th, 2018. It's a Wednesday. Listen, guys. The markets have went into a cycle here. They've went into a process that's like a wash, rinse, repeat. That's what it is. It's basically a wash, rinse, repeat. What happens is the markets, the equity market, the stock markets, what they do is they go down, they have a fall, right? And while they're falling, you watch the bond market. The bond market responds because bond yields, they fall too. Bond yields fall while the market is falling. So the money is moving out of the markets because the markets are so highly overpriced. And what's happening is the money's moving into the bond market, which is a bigger market than the stock market, right? And so what happens is as soon as the stock market starts to recover a little bit, it doesn't recover as much as what the bond market does. As soon as the pressure comes off the bond market, what we see when the stock market starts to go back up a little bit, the pressure comes back off the bond market. What happens is immediately the bonds start to respond and the bond yields start to rise. Not only that, when the equities, when the stock market starts to go down, it doesn't affect the bond market as much as it actually should. So in other words, what we're doing is we're not moving the bond market very much, but we're moving the stock market a lot to do so. And so what's happening is we're getting these periods where the stock market goes down. It doesn't come back up to where it was. We're not getting a huge rally back. And then we're getting this action in the bond market. And this cycle, this is like a cycle that started. It's a cycle that's going in the markets. And this cycle's going to continue, and it'll keep jig-jagging that stock market down, 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 until the final bottom's reached around 14,000 points. I still stick by what I said. If the Fed's got control over all this, by the way. Anytime they want, they can stop this process. All they got to do is say uncle. Basically, this is the way it works. Do you remember the old game the kids used to play? Used to grab their head and used to scrub their head with a noogie or whatever. Used to rub their head like this until they'd say uncle, the other kid. You'd have him down on the ground. He'd have him in a hold like he couldn't get out of, and he'd be rubbing his head with his hand, until the kid say uncle. Well, that's what this whole thing is the Fed's going to have to say uncle to stop this. It's going to continue. And so it's going to be a wash, rinse, repeat with the stock market slowly rolling over. And it's literally, there's no money coming into the system. They've got the system in a chokehold. There's no money that's going to be coming into the system. The money's going to be going out now. We've went through the tax rebates things. We've went through all that kind of stuff now. We're right down to the nitty-gritty now, and the Fed's hauling $50 billion a month out of the system. And so now we've got this wash, rinse, repeat cycle that's happening in the stock market, where the stock market is just going to keep going down, 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 until the people start to panic, and then it's going to go down even faster. It's going to start to be a self-perpetuating, self-feeding cycle at that point. So let's take a look at the markets. Let's get in there and take a look and see what's going on today, and take a look at this wash, rinse, repeat cycle by opening the charts right here. Okay, and the first thing we're going to take a look at is cryptocurrency. We see Bitcoin is not responding well to this deflation that's starting to happen because of the liquidity being drawn out of the system. It's not responding well to it, cryptocurrency. I quite figured that the direction, when the stock market rolls over and the stock market goes down, the direction that cryptocurrency is going to take us down too, because it's not really fully made the transition between a speculative investment and a safe haven asset. Cryptocurrency is still a speculative investment. It hasn't found its real-world uses yet. Actually, it's not actually being used in these real-world uses yet. It's got areas where it's going to move into. Everybody knows it's going to take over certain areas, but it hasn't done it yet. Certain sectors, they're still using the old SWIFT system. So Ripple's planning on replacing the old SWIFT system, but they're still using the old SWIFT system. Money transfer services and all these different things where it can be used on a real-world basis. It can be used on a real-world basis, but it's not being used yet in the overall sense, in the general sense. They're still using fiat. You know, I mean, just go down to your local corner pharmacy and haul out and try to pay with Litecoin. You can't, but haul out some dollars and you'll be able to pay. I mean, it's simple. So Bitcoin could roll over pretty bad during this crisis that's coming. What I mean roll over is, I mean, basically crash. Let's take a look at silver. I still stick by my guns that when this crisis hits and we get really into the muck of it and the fear enters into the market big time, when the stock market goes down below 20,000, I still say that they're going to turn to gold and silver, because this is a safe haven asset. It always has been a safe haven asset, and it is the ultimate safe haven asset. And in my mind, it always will be. They're never going to be able to totally replace gold and silver with anything. But this is the ultimate safe haven asset, and so it's going to really respond. I've picked three things that that are going to respond really well during the actual deflationary part of the crisis. Gold, silver, and cash. Those are the three things. And so what we see today was we see silver price at 1404. Boy, she's had a rough go over the last couple weeks, you know, the silver price. Let's take a look at gold. Gold is at $1,200.80, and it's had a hard go, too, over the last little while. Well, let's take a look at the Dow Jones Industrials today. And we look like we're up 166 points. But see, this is the day during the wash, rinse, repeat cycle where the Dow goes back up some again. But you notice it's not going up near as much as it came down. 166 points up is no real big deal when it's coming down like 600 points, you know. So that's the wash, rinse, repeat. Because if we take a look over here at the bond market in a second, so see if we see a few up days in the Dow, say 3 or 4 up days. During those up days, we got to watch what the bond market's doing and how are those bonds responding. So now let's take a look now at oil prices. Oil prices are up a little bit today, 1.65%, $56.61. I mean, that's not a real big amount up considering the amount we've been down lately. I mean, we were up over $70 there a little while ago, for crying out loud. Look, 56.61. That's not that great. Respond back up. I mean, you know, it's really down over the... So it's bouncing back a little bit. It could be in that same seesaw pattern that I was telling you about. That seesaw's up, seesaw's down more than it comes up. I mean, in other words, lower highs and lower lows, you know. I mean, just constantly. Okay, so here's cryptocurrency market capitalizations. I probably should have done that when I was on Bitcoin. But what we're looking at is $204 billion. Now, we were up to 219 just like yesterday or the day before. 219 billion. Now we're at 204 billion. She's losing steam. Bitcoin dominance 53.2%. So we see all the coins, and most all of them are in the red, going down, you know. We're losing market capitalization. Look at the coins I like to look at here is one of the coins I like to look at is Litecoin, and $50 is kind of the mark I set here. It's at 48.47, so it's under the $50 mark for a Litecoin. It's getting really cheap. There might be a time coming very soon when it's time to load up on these coins, if you can possibly do it. Because ultimately, these coins will become a safe haven asset down the road in the future. It might take a couple years, you know, but these coins are going to become the in thing. They're going to be the big thing. When fiat currencies, when the big trouble comes for fiat currencies, because let's face it, these coins are in competition with what? These coins are in competition with fiat. They actually mean to replace fiat. These are cryptocurrencies. Fiat is fiat currency. And these actually mean to replace fiat. They're standing in. In other words, it's kind of like a stand-in in a play or something, you know. He's ready to move in and play the role of the actor if something happens. It's like a stand-in. It's like these are like a stand-in ready to go. And the something that's going to happen that's going to take down the fiat currencies is this ginormous everything bubble bursting that's going to happen right away, right soon. And so where do you think they're going to go? And once they start to run into these cryptocurrencies really big, if you thought them running in was big when they drove it up to $750 billion market cap a few months back and drove Bitcoin up to 20,000, if you thought that was big, that ain't nothing if the fiat currencies are dying and these are replacing them. You haven't seen nothing yet. Okay, let's take a look at bonds and rates today. Now, what do we see here? We see the bond yields taking off. They're taking off this morning. As the stock market's moving up a little bit, these bond yields are starting to really jump. And so these are moving. And so what we're seeing is this wash, rinse, repeat cycle where the bond yields move up faster and they bounce back faster than the stock market moved down. And the stock market stays sluggish and it goes up a little bit, but it doesn't make it up to where it was before it fell. But the bond yields do. They're like shooting up fast, and the next thing you know, you get this pulse where the bond yields have went up back where they were when the stock market first started to roll over, but the stock market hasn't made it back up yet again. And it's just this wash, rinse, repeat cycle where the stock market will keep going down lower and lower and lower and lower, and the bond yields will just keep going up higher and higher and higher. And ultimately, in the end, unless the Fed stops this process, it'll take the market down as low as 14,000. The Dow Jones I'm talking about. And right now we're like, what, 25,000, okay, we're at 25,445. So we could drop like easy a 9,000 points on the stock market. What kind of a crisis would that be? A big crisis, big crisis. That's what kind of crisis it could be. The fear is going to come when it crosses down below that mental barrier of 20,000. When it's back down like 19,000 and something, the Dow Jones, that's when they're going to be out there using the mainstream media to preach disaster. And they're going to do things, I believe, to try to make the people out there think that, hey, this is the sky falling, this is really bad. And one of the things I'm kind of expecting them to do is they're not going to let the really big institutions go down that actually own the central bank. They're not going to let them go down. They're going to let the mid-range institutions, they might let a couple of those go. Just like they did in 2008. They're not going to let the really big institutions, they're not going to let the biggest banks go down. Because that's their mandate, to protect those biggest banks. But they could let a few credit unions and stuff go down. They could let a few of the smaller banking institutions go down. Just to prove their point. To say, hey, look, this is a terrible crisis we're having. This institution or that institution has went down. You know? And by letting these institutions go down, not only that, they're able to consolidate their power. You know? And this is what they've been doing all along. They're like a blight. Honest to God, they're like a blight on America and the world. The central banks. They're a blight. That's what they are. Anyway, listen, Thank you guys for listening. Oh, here we go. The U.S. dollar index. I didn't even say what the dollar index. I was so excited about the central bank and everything. 97.11. See, we're over the 97 point where the emerging markets have problems. But we're not a long way over 97. We just basically went up and touched 97. Let's see. I think she's going to go higher, though. I'll tell you honestly. The dollar, because it's like right now, the way things are set up, where else are these investors going to go? There's nothing really out there for them that really looks as tempting to get into right now as the dollar. And also, the success of the dollar. You see the dollar going up in value. This success breeds success. Success breeds success. So if they see the investors see the dollar going up in value, they want to get on that train. They want to get onto that. They want to get on something that's going up in value. Where they see gold and silver going down, it's miserable down. They don't want that. They don't want that. The real big investors, you know, they don't want to get on something that's going down. They want on something that's going up. Ultimately, though, by the time they have to make the shift, when the dollar really goes down, they have to make that shift and they have to get out of this dollar quick. The dollar's going to go down so quick when it goes down that it's going to be a mad rush to get out of it, and by that time you're going to have to pay an awful lot more for things like gold and silver and cryptocurrency and things like that to get out of the dollar, because the dollar's going to be on an elevator to hell, while all of these other things are going to be counterbalanced and they're going to be going to the moon, you know, and that's the way it's going to be. Thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.